Good morning, everyone. Let us come to bond valuation chapter. The topic is duration. We have seen how to calculate duration. First formula to calculate duration is summation of present value into year upon summation of present value. And the second formula to calculate duration is current yield upon YTM into PV annuity factor for the YTM and number of years into 1 plus YTM plus 1 minus current yield upon YTM into N. Either of these two formulae you can use. And then we had seen some properties of duration also. Duration of a zero coupon bond is equal to its maturity. Then we have seen the formula of modified duration. Modified duration is for calculating the volatility. You can also write all formulae at one place. Will be duration upon 1 plus YTM. So what modified duration tells you? If YTM changes by 1%, the bond price will change approximately by so many percentage. So if modified duration is 3.5, if YTM changes by 1%, bond price will change by approximately 3.5% on opposite side. If YTM increases, bond price will decrease. If YTM decreases, bond price will increase. Duration gives you approximate right answer. Duration gives approximate answer, not accurate answer. Not accurate answer. So yesterday I told you we will discuss why duration gives approximate answer, not accurate answer. So understand, if you look at this relationship between YTM and the price of the bond, the relationship between YTM and price of the bond is a curve, not a straight line. The relationship is not a straight line. But what duration assumes? Duration assumes that there is a linear relationship between the YTM and the price of the bond. So there is a problem. Duration says 1% change in YTM, 3.5% change in price, which means 2% change in YTM means 7% change in price, 0.5% change in YTM, 1.75% change in price, but it will not happen. Is it right? It will not happen. Why it will not happen? Because this relationship is curve. So the change will not always be linear. This is linear relationship, but the change will not be linear, it will be curvilinear. So therefore, if there is a small change, let us say the change in YTM is very small, the two will almost be equal. But if the change is large, change in YTM is large, according to duration this will be the answer, but the actual answer is different. Actual answer is different. Similarly, if the YTM falls, according to duration this will be the answer, but the actual answer is different. So if the change in YTM is by a higher percentage, if the change in YTM is by a higher percentage, then duration does not give you accurate answer, it gives you approximate answer. But if change in YTM is by small percentage, then duration is close to the accurate answer. So this is the limitation of duration. So now we'll come to one question number 49. Please come to question number 49. The following information is available on a bond. Question number 49. So today we'll take some questions on duration. Are you ready? Source is from a reference book, a financial management book. The following information is available on the bond. Face value is rupees 100. Coupon rate is 12%. Payable annually. Years to maturity 6 years. Current market price is 110. What is the duration of the bond? In order to calculate duration, you will require year column, cash flow column, present value factor at YTM, which is not given, present value, year into present value. So I need a discount rate. Is the discount rate given in the problem? Discount rate is not given, coupon rate is given. Can I say discount rate is equal to the coupon rate? The answer is no, because the bond is trading at premium, not at par. If the bond would have been trading at par, then I would say the discount rate is also 12%. But in this question, the bond is trading at a premium, so discount rate is not equal to 12%. So we'll have to work first and find out what is the YTM, and that I will use as a discount rate in solving the problem. So this is a dangerous question because students can use 12% discount rate, which is not right. So step 1 would be, we'll first calculate YTM. First we'll calculate YTM. Step 1, calculation of YTM. Calculation of YTM. YTM is equal to C plus FV minus CP, FV minus CP, FV minus CP upon N upon FV plus CP by 2 upon FV plus CP by 2. So write the answer now. I'll give you the answer. Please answer. Please reply. %. One student is saying 9.8%. So very good. 9.8% is approximate answer and it is right. 9.84% is right. 9.84% is right. Then come to step 2. Step 2 is calculation of duration. Step 2 is calculation of duration. Calculation of duration. We will use that 9.84% as a discount rate. So format is year. We can solve by formula method also. We can solve by tabular format also. Year, cash flow, discounting factor at the rate 9.84%, present value, into year, present value into year. Okay. So now you solve. This is a 6-year problem. Coupon rate is 12%. Face value is 100 rupees. So 12% of 100, 12 rupees, and then 112 in the last year. 112 in the last year. Calculate factor first. Factor will be 1 divided by 1.0984. 1 divided by 1.0984 equal to, so you will get 0.9104. Again press equal to 0.8286 equal to 0.7546 equal to 0.6870 equal to 0.6255 again equal to 0.5694. Now please complete the table yourself. Tell me the present value total here. Please give me the total of present value and give me total of PV into year. So try fast. This is the answer. You should get approximately 110 rupees because 110 rupees the price of the bond today. Using 110 rupees you have computed YTM. So using the same YTM you should get 110 rupees. But because of some rounding off you may get little different from 110. Is right 110 or close to 110? Yes. Now you complete the last column, year into present value column, year into present value. Use memory plus function, 1 into 10.92, 2 into 9.94, 3 into 9.06 memory plus, 4 into 8.24 equal to memory plus 32.96, 5 into 7.51 memory plus, 6 into 63.77 equal to memory plus 382.62. 382.62. So now you solve, take the total, check the total. Yes, Divya is the total, right? 511.11. Muralidhar is the total, right? Okay, so note down these two numbers. Approximately you should get the same answer, and below that write down duration of the bond. Duration of the bond is equal to total of the last column 511.11 divided by total of present value 109.44. So what is the answer? Come on fast. What is the answer? 4.67 year. Is it right? Is it right? 4.67 year. Okay. So this is the small simple question, but students make mistake. They do not calculate YTM and they solve directly. No problem. Come to next question number 50. This is from your exam November 2005. The following data are available for a bond. Face value 1000, coupon rate 16%, years to maturity 6, redemption value 1000. This time they have given you YTM. So no need to calculate YTM. Use 17% discount rate. Question is, what is the current market price? So using 17% discount rate and this cash flow, find out the price. Then you can also find duration. You have to also find volatility of the bond. So modified duration. And then you have to also calculate the expected market price if increase in required yield is by 75 basis point. If increase in yield, if YTM increases by 0.75%, 75 basis point means 0.75%. So bond price will fall. But bond price will fall how much? That you have to find, and find the new price. So this type of question they ask in the exam sometimes. So we can find the first and second answer using same tabular format. Yes or no? We can find current market price and duration by preparing same format. So please write calculation of current price and duration. The total of the fourth column is the current price of the bond. And the last column total divided by fourth column will give you duration. Very easy. Practice is required. This question is also for 6 years. Coupon rate is 16% of 1000. 16% of 1000, 160. And in the last year, you will write 1160. Last year 1160. Okay. Then calculate the present value factor. 1 divided by 1.17, 0.8547. Press equal to again 0.7305. Press equal to and write down the factors. These are the factors you will get. Check if it is right. Is it right? Now compute the present value, multiply these two columns, multiply equal to memory plus, and then at the end you can use memory recall function for the total. Check the answer now. Multiply equal to memory plus, multiply equal to memory plus, do it. And now I want you to give me the total here. If you want to copy, you will have to wait. Anybody total of the present value? Yes. $962.92. Approximately, you are right. 964.07. I have got some difference is possible. Some difference is possible, so don't worry. Approximately you must get the same answer. Now you multiply year into present value and use memory plus function. 1 into 136.75 memory plus, 2 into 116.88 memory plus. This way you continue and give me the total of the last column. Give me the total of last column. Last column total. Yes, come on. Last column. So this is approximately check 4089.68. Is this right? Is this right? So now write down duration. Duration of the bond is equal to, take the total of last column 4089.68 divide by 964.07. Approximately what is the answer now? Yes, students, please reply. What is the answer? Is it 4.24 years? Yes or no? Is it 4.24 years? So 4.24 year is right. Okay. Now we'll come to next, modified duration. Modified duration is equal to duration upon 1 plus YTM. Correct? So from duration we will get modified duration, and that will help us to calculate the percentage change in price of the bond. So tell me the answer now. 4.24 divided by 1.17, that is equal to, check the answer, is it right? 3.62. Is it 3.62? Yes. So the students have got the same answer. So my second question is that what is the volatility of the bond? So write down, percentage change in price of the bond equal to, percentage change in price of the bond, percentage change in price of the bond equal to minus modified duration into change in yield. This is the purpose of learning duration. We can estimate by what percentage bond price will change. Modified duration is 3.62. I'll put a minus sign here because the bond price will fall, because yield has increased. If yield increases, bond price will fall. So bond price will fall by 2.719%. Bond price will fall by 2.719%. And then the last part of the question is, what is the expected market price? So write down expected market price of the bond. Expected market price of the bond is equal to original price minus original price into percentage change in price, or you can just write 964.07, which is my answer in the table, minus 2.719%, minus 2.719%, minus 2.719%. So the approximate answer would be now 937.89. 937.89. So if the YTM increases, bond price will decrease. In this example, if YTM increases by 0.75%, bond price will decrease by 2.719%, and the new price, expected price, will be 937.89. Okay. Have you done? All of you have done? Say yes. Okay, now we'll come to another different question, number 52. 51 I will solve after some time. First we'll solve few easy questions and then we'll take some more advanced questions. Question number 52 is a zero coupon bond. Sorry, it is 53. 53. This is 53. A zero coupon bond. Zero coupon bond means the term to maturity and duration will be same. Zero coupon bond of 10,000 has a term to maturity of 8 years. Market yield at the time of issue is 10%. So 10,000, 8 years and 10% discount rate, you can compute the present value or issue price of the bond. Second question, duration of the zero coupon bond. Answer is 8 years only. What is modified duration of the bond? Duration upon 1 plus YTM. And if 100 basis point remove the percentage sign here. If 100 basis means 1%, 100 basis point is equal to 1%, were changed in the yield. So if the yield changes by from 10% to 11%, find its impact in the price of the bond. By what percentage bond price will change, and then you have to prove also. That means using present value, you have to prove that the bond price has changed by so much percentage as you have mentioned in your answer. Okay, so this is one of the easiest question. I wanted to take one question on zero coupon bond, so I have taken this question. Write down step 1. Start from here. Present value of the bond is equal to, because this is zero coupon bond, you will only get 10,000 rupees on maturity, and you will compute the present value. So 10,000 into PV factor 10%, 8 years. Solve 10,000 into, check the factor of 8 years and 10%. So that is 0.4665. That is 0.4665. Is it right? So the answer is approximately the issue price, in bracket write issue price is 4665. Second answer is the simplest question ever heard. What is the duration of this zero coupon bond? So you don't have to do any calculation. Okay, enjoy. Just write one line. Duration and term of the bond are same. In the case of zero coupon bonds, that is 8 years. So duration is equal to 8 years. Now the next question is, what is modified duration? So write down answer C. Volatility or modified duration. If they ask what is volatility, also do the same thing. Volatility or modified duration is duration upon 1 plus YTM. Duration is 8, YTM is 10%, 8 upon 1.10. What is the answer? Yes, please answer. 7.27. Just check it again. One student said 7.23, but it should be 7.27%. So what does that 7.27% indicate? That if the YTM changes by 1%, price of the bond will change by 7.27%. Write a note. Observation. Devika is right. 7.27. Very good. Right. If YTM increases by 1%, price of the bond approximately, underline approximately, not accurately, approximately slides by 7.27%. So now I have to prove this point, because the question says if 1% were changed in yield, how will it impact the price of the bond? So we are saying price of the bond will fall by 7.27%, but the question says prove also. So write down proof. So I will prove by using the present value factor. So heading, write down proof. Suppose the YTM increases to 11%. What was the YTM earlier? 10 plus 1. So assume that YTM goes to 11%. So how the bond price will change and by what percentage the bond price will change. So first you write down present value is equal to 10,000 into PV factor, 10,000 into PV factor in bracket 11% comma 8 years, in bracket 11% comma 8 years. So solve it, you will get the answer 10,000 into 0.4339. Students are requested to check and the answer is 4339. Understood? Now let us see by what percentage the bond price have decreased. What percentage, by what percentage bond price have decreased. So take the previous answer 4665 minus this answer, divide by previous answer. So 6.98, oh my god, 6.98, and you have written 7.27. So you should say, sir, it is not matching. I already told you it will not match because duration will help us to only calculate approximate change, not accurate change, because duration assumes linear relationship, whereas in reality the relationship is a curve, not linear. Hence you always have a difference. So the difference is due to the fact that duration gives you approximate answer. So I will give you a note here if you want to write. The difference is due to the fact that duration gives approximate answer. Duration gives approximate answer is due to the fact that duration gives approximate answer. Is it right? So this was just an easy question for understanding. Now we'll again take one exam question on the same topic, duration, asked in May 2004 exam, question number 54. Just below that, question number 54. Consider a bond selling at its par value of rupees. Selling at its par value. This is a hint. What is the hint? The hint is that if the coupon rate is 7% and redemption is also at par, please tell me what is the YTM. Quickly reply. What is the YTM? What is the YTM? 7%. Very good. So even though they have not given in the question directly, but indirectly this is the hint that the YTM is 7% with annual coupon payment. What is the bond's duration? This question A was for 6 marks and I have written a note that if bond is selling at par, it means coupon rate and YTM are equal, that is 7%. So write down this note first. Write down this note in the answer. Write down this note in the answer. If YTM, if the bond is selling at par, this note, if the bond is selling at par, it means coupon rate is equal to YTM is equal to 7%. Coupon rate is equal to YTM is equal to 7%. If you don't know this, then how will you solve this question? Because you will require a discount rate. No need to compute the YTM because you will get 7% only. Then they have changed the question suddenly. If the YTM of the bond in A above increases to 10%, earlier it was 7, now it is going to 10, how it affects the bond's duration? So recalculate the duration of the bond. Recalculate by using 10% discount rate, and the question is why the duration has got affected. So we have seen one property of the duration How will duration be affected if YTM increases? You have seen in one of the properties of duration. So you have to answer what will happen, whether the duration will decrease or increase. What is the relationship between YTM and duration of the bond? YTM and duration of the bond. If YTM increases, what will happen to duration of the bond? Increase or decrease? We have done that in the properties. Okay, you keep thinking. Next question, why should duration of a coupon carrying bond always be less than the time to maturity? Theory question. Why duration is less than term to maturity? So this also is for 3 marks, right? So first we'll write down calculation of duration. First, original question, calculation of duration. I hope you have written the note that coupon rate is equal to YTM is equal to 7%. Okay. So first chance to you, I'll give you 30 seconds. Give me the duration. So your duration to solve this question is 30 seconds. Solve fast. You have 30 seconds. Answer please. What is the present value total? It should come to 1000 because 7% is coupon rate, 7% is discount rate. So you should get present value 1000. After that, solve the last column. Yes, anybody last column total? Last column total. Total of the last column. Check the answer. Is it right? Please reply. Is it right? Yes or no? So total of the last column, note down 5099.93, and this should be approximately 1000 because coupon rate and discount rate are same. 5099.93. This divide by this will give you duration. So kindly write down below, duration of the bond is equal to 5099.93 divide by, you can write 1000 or you can write 999.96. So is the answer 5.10 years? Is the answer 5.10 years? Yes. Then we have to again calculate duration when YTM is 10%. So write down calculation of duration when YTM is 10%. Calculation of duration when YTM is 10%. Calculation of duration when YTM is 10% according to second question, and then you have to explain why the duration has gone down. Why the duration has gone down. So first you write down the format. And then solve. I'm expecting this time you should answer now. Come on, student, come on. What is the present value? Yes, Devika, what is present value column total? Divya, Mr. Hari, so check the answer. If you have done, the present value is 869.36. Now try the last column. Try the last column. Try the last column. The last column total is, you can just note down for the time being, later on you can check. If it is different, then tell me. 4369, is it same or different? Four zero three six 4369.751. Okay, so take this number, last column, divide by present value, and what is the duration? Yes, come on, reply fast. So the answer is, write down below, duration is equal to total of the last column 4369.751 and total of present value 869.36. So check the answer. Is the answer 5.02 years? Is the answer 5.02 years? Yes, come on. 5.02 years. Okay. And then there is a question, why the duration has gone down? So write a note. There is an inverse relationship between YTM and duration. There is an inverse relationship between YTM and duration. Hence, when YTM increases from 7% to 10%, duration decreases. Duration decreases. That was the answer of part B of this question. What is part C? Read the part C again. Why should the duration of a coupon carrying bond always be less than the time to its maturity? Because some cash flows are recovered in the earlier year. Hence, the duration is always less than time to maturity, because some cash flows in the form of coupons have been recovered in the earlier years. So, very good, Divya, you've got it right. Now tell me the last answer, write down. Answer of part C. Right, answer C. Sometimes they ask theory question also. So write, why duration is always less than time to maturity? So write down two lines for that. Duration is the average time. Duration is the average time taken by an investor. Duration is the average time taken by an investor to collect his investment. Duration is the average time taken by an investor to collect his investment. If an investor receives, next line, if an investor receives a part of his investment, if an investor receives a part of his investment over the time on specific intervals before maturity, the investment will offer him the duration, which will be lesser than the maturity of the investment, If you receive some cash flows earlier, then of course the duration will be less than the term to maturity, because we give weightage to earlier cash flows also. So that was the answer of this wonderful question. Any query? Yes, all of you are silent today. No query. Now we'll come to question number 52, which is pending. Very, very important. Write down. Very, very important. Question number 52, exam question for 6 marks. Find the current market price of the bond having face value rupees 1 lakh, redeemable after 6 years, maturity with YTM at 16% payable annually, and duration is 4.3202 years. Oh my God. In this question, we have to find current market price of the bond, and you are given duration of the bond, So I will give you 30 seconds to try your luck. You have to give me current market price of the bond. Okay. So I will wait for 30 seconds. You will try. Suppose this question appears in your exam, then what will you do? So please try. Let us see how many of you are intelligent students. Keep trying. Anybody answer? Those who are studying online, please reply, please participate. What is the current market price of the bond? What is the current market price of the bond? That is the question. Challenging question now, after solving so many simple questions. I am waiting for your answer. No answer till now. Okay. So should I solve? You want some more time? Yes. So how do we solve this question? We are not given the coupon rate also. We are not given coupon rate also. You can't assume coupon rate is 16% because YTM and coupon rate are not the same thing. If you assume coupon rate is 16%, then there is no need to solve. The answer will obviously be 1 lakh. So why we need this question? So coupon rate is also missing here. So can we assume that the annual coupon amount is X? Can we assume that the annual coupon amount is X and then solve the problem and try to find duration using X and equate the answer that you get, which will contain X, with the duration given in the problem? You will get the value of the X. So value of the X means you will be able to find out the coupon rate and then you will be able to easily find out the price of the bond. Okay, so that was the trick involved in this question. So please write down, let annual interest be X. Let annual interest be X. Let annual interest be X. Then write down calculation of duration. Solve like a normal question, but instead of coupon amount, we will put the value as X. So write down year, cash flow, discounting factor at 16%, present value into year, present value into year. So then you write down year column 1, 2, 3, 4, 5, 6. Coupon amount we have assumed to be X 5 times, and then in the last column you will write 1 lakh plus X. You will write 1 lakh plus X. Okay. Then calculate the discounting factor. The discounting factor at 16%, 1 divided by 1.16. 1 divided by 1.16. 1 divided by 1.16. 0.862, 0.743, 0.641, 0.552, 0.476, 0.410. Now calculate the present value. So you will write like this: 0.862x, 0.743x, 0.641x, 0.552x, 0.476x, and the last one will be 1 lakh into 0.410 is 41,000 plus 0.41x. Up to this is right. It was simple, but that student must practice such question. Maybe in the last minute of the exam you will not be able to understand how to solve in the given time slot. Now you take the total of all these numbers which have X in it and write the total below. So the total comes to 41,000 plus 3.684x. Check the answer, 3.684x. Now you do the same thing in the last column. 1 into 0.862x, 2 into 0.743x, and 3 into 0.641x, 4 into 0.552x, 5 into 0.476x, and the last one will be 2,46,000 plus 2.46x. Again, what you do? First you take the total of all these numbers with X. Take the total, please. The total will come to something like 2,46,000 plus 11.319x. Approximately check. Now what we'll do? This divide by this is duration. which is to be equated with the duration given in the problem 4.3202. Can you see that? So the total of last column divided by fourth column total is equal to 4.3202, and then you will be able to get the value of X, but that is not the answer, that is the coupon amount. This column total represents price of the bond today. So after getting the value of X, put the value here and you will be able to calculate the price of the bond today, and that will be your final answer, and you will get 6 full marks. So write below, duration of the bond is equal to 2,46,000 plus 11.319x upon 41,000 plus 3.684x. This should be equated with 4.3203. 4.3203 is equal to 2,46,000 plus 11.319x upon 41,000 plus 3.684x. Solve. Now you can at least solve and give me X. Let me see who will give answer first. Come on, come on. Anybody who is able to find the value of X. So it comes to approximately 15,000. Check. Please tell me if it is right. 15,000, is it right? Approximately. Now 15,000, if I put the value of 15,000 in the total of fourth column, total of the fourth column is the price, you will be able to calculate the current market price of the bond. So if you are getting 14,985 or something, you can round off to 15,000. You can round off to 15,000. You can say 15,000. 14,985 comma say 15,000. Even if you write 14,985, it's okay. Don't bother. Okay. So now you put the value in the total of the last column. So write down last line of the answer. Current market price is equal to 15,000 into 3.685, that is the present value of coupon, plus 41,000, which is the present value of face value, and the answer is 96275. The answer is 96275. Is it right now? So that was a question asked in the exam. Reverse working. From duration, you have to find coupon amount and the price of the bond. And if they ask you coupon rate also, then the coupon rate will be 15,000 divided by 1 lakh. If suppose in your next exam, they ask you what is coupon rate, then you will say 15,000 divided by 1 lakh is 15%. Coupon rate is approximately 15%. This is not a part of the answer, but in the next exam if they ask you, you can do it. So learn something more. Now we'll take a very, very important question, number 51. This question was asked in November 2005 exam for 8 marks. If you see, question number 50 plus 51, both are from November 2005 exam for 8 marks each. which means in November 2005 there were 16 mark weightage on this topic. Okay, there was a weightage of 16 mark. So very good, Roshni, you can keep replying. So come to question number 51. Write down important. One day you will also become fund manager and you will have to solve questions like this practically. The investment portfolio of a bank is as follows. The investment portfolio of a bank has got 5 bonds in the portfolio, and we have seen one of the properties of the bond. The duration of a portfolio of a bond is weighted average duration. Duration of the portfolio of a bond is weighted average duration. Then they have given you coupon rate, purchase price. What is written in bracket? Face value rupees 100 per bond. Face value rupees 100 per bond, but purchased for 106.50. Purchased for 105, 110, 101. So face value is 100, cost price is 106.50. Okay. Then they have themselves computed the duration. Enjoy. Your institute is so kind, so nice. They have given the duration on a plate. So you have to just do the basic calculation, because the duration of each of these bond is already calculated by the institute. Now don't sit there and check whether it is right or wrong. If it is given in the problem, then it is to be taken as it is. Okay. Now below, face value of total investment is 5 crore in each bond. So face value is 5 crore. If 100 rupees face value, 106.50 is the cost. If 5 crore is the face value, what will be the cost? What will be the purchase price? What will be the purchase price? So that is my first question. Compute the actual investment in the portfolio. The actual investment in the portfolio, you have to compute what is the actual amount invested in this bond. If 100 rupees the face value, 106.50 is the purchase price. So if 5 crore is the face value, what is the price? So that you can find by using simple school level arithmetic. 106.5 into 5 divided by 100. Same way you can do the calculation for all the 5 bonds, and you will be able to get the total amount invested in each bond. This question is an arithmetic question. 10 standard student can also get that answer, but your intelligence will lie in answering the next 2 questions. What is a suitable action to churn out? Churn out means change, shuffle. What is a suitable action to churn out the investment portfolio in the following scenario? So what will you do with your portfolio of investment? Will you buy or sell? And which bond you will buy or which bond you will sell? There are 2 scenarios, means there are 2 situations, you have to answer both situations. Interest rates are expected to be lower by 25 basis point. Interest rate means market interest rate. Coupon rate is already locked. So what interest rate they are talking is market interest rate. Rate of interest in the market, suppose, is expected to lower by 25 basis point. So suppose the RBI governor is going to reduce the interest rate in the next monetary policy by 25 basis point. After knowing this, or after expecting this, that this year this time the RBI is going to reduce the interest rate by 25 basis point, what action as a fund manager, as a portfolio manager you are going to take? are you just going to remain quite as it is, or are you going to reshuffle your portfolio? If you are going to reshuffle your portfolio, then which bond you are going to buy and which bond you are going to sell. And then the reverse question, interest rates are expected to rise by 75 basis point. Suppose you have an expectation that the RBI governor in the next monetary policy is going to increase the repo rate or interest rate. After having such expectation, what action as a portfolio manager you will take? So keep thinking about these two questions that will test your intelligence. Also calculate the revised duration. Revised means you have to also calculate original duration of the portfolio and revised duration of the investment portfolio in each scenario. Okay, so once you advise, what you have to do, based on your advice, you have to calculate the revised duration of the investment portfolio. So first answer first. First answer is a simple school level arithmetic question. If the face value is 100, the cost is 106.50. If face value is 5 crore, what is the purchase price? Write down in the notebook. Question number 51. First answer you can get it without any effort. Calculation of actual investment in the portfolio. Calculation of actual investment in the portfolio. So please write down this format. Presentation is also important in the exam. Shortcut will not help you. First column government bond, second column purchase rate, in bracket face value rupees 100 per bond. These two are given in the problem. Third column write calculation and last column write actual investment. Last column write actual investment. So write down in the government bond column, same copy. This question is very important for your upcoming exam. GOI 2006, GOI 2010, GOI 2015, GOI 2022 and GOI 2032. GOI means government of which country? India, Iran, Indonesia, Ireland or Iceland? So government of India. Very good. Calculation. 5 into 106.50 divided by 100. So the amount invested in the first bond is 5.325. Right here rupees in crores. Rupees in crores. Okay, continue in the same way. The next answer is 5.25. Again 5.25, 5.5, 5.05. Total of the last column is your actual amount invested in the bond portfolio. 26.375. 26.375. Okay. Now please reply, since you are learned student. First question is over. Second question is, what is a suitable action to churn out the investment portfolio in the following scenario? One more thing I have to do first. First I will compute the duration of existing portfolio. Duration of existing portfolio, there are 5 bonds with 5 different amounts invested and they have separate duration. So I will compute weighted average duration. So first you do this part. This is quite easy. Calculation of duration of existing portfolio. Calculation of duration of existing portfolio. calculation of duration of existing portfolio. Same easy format, government bond, duration, investment, duration into investment, duration into investment. Then copy the duration from the question book. Copy the duration from the question book. Investment amount will be used as weights. Investment amount will be used as weight. And from where will you get the investment amount? From the first working note. So go to the previous table and from there you will copy the investment amount 5.325, 5.25. You can see in your own notebook 5.25, 5.50 and 5.05. Multiply these two columns. Multiply these two columns. Use memory plus function. Multiply equal to memory plus. Multiply equal to memory plus. Check the answer from my answer, and if there is a difference, immediately inform me. Is there any difference? No. Okay. Take the total of the last column. Take the total of the last column 205.913 and total of investment column also 26.375. Total of this column divided by total investment will give you weighted average duration. Or you can do one more thing. You can first convert this investment amount into respective weights. Investment amount can be converted into respective weights and then you will multiply weight into 3.5. So that will also give you same answer, but that will involve one more step and that consumes more time. So write down below the table weighted average duration. Weighted average duration is equal to 205.91 divided by 26.375 is equal to 7.81 years. Is equal to 7.81 years. Okay. So this is my existing duration. Now please come to your question. It is written, what is a suitable action to churn out investment portfolio if you are expecting interest rate will go down by 25 basis point? So if market interest rate will go down by 0.25%, what will you do with respect to your portfolio? Will you buy bond or sell bond? Which bond you will buy and which bond you will sell? That is the meaning of churn out. Which bond you will sell and which bond you will buy. So if when market interest rates are going to fall, bond value will rise. That you have understood. Which bond will rise by a higher percentage? Bond with higher duration. Bond with higher duration will have higher price appreciation. Higher the duration, higher the price sensitivity. So you will profit more. You will profit more if the duration of the bond is higher. If the duration of the bond is high, for the same change in YTM, it will produce a higher impact on the bond price. So now I have given you enough hint. Tell me which bond you will buy and which bond you will sell. Please reply. Which bond you will buy and which bond you will sell. Should you buy 2006 bond and sell 2032 bond, or should you sell 2006 bond and buy 2032 bond? You have to increase the duration of the portfolio. Duration of the portfolio can be increased by putting more money in bonds of higher duration and less money in bonds of lower duration. So the answer of this part will be, you will sell bond which have lower duration, that is 2006 bond, and you will invest in bond which have higher duration, which is 2032 bonds. So that way your average duration will go up. If average duration will go up and if YTM falls, you will have a higher price appreciation in the bond value. So write down case 1. Case 1, write down case 1. Interest rates are expected to lower by 25 basis point. One day if you become fund manager, you also have to face this, because interest rates are continuously fluctuating. Sometime RBI reduce the rate, sometime they increase the rate, and you are holding bonds of so many crores of rupees. So changing interest rate will impact the bond value. So what you will do, write down, in this case the strategy should be to increase the average duration of the portfolio. The strategy should be to increase the average duration of the portfolio. That is, the portfolio manager should sell the bonds with lower duration, and buy the bonds with higher duration, So increase the average duration, you will get more price appreciation. Now write down reason. In the exam, reasoning is not required, but as a student you should know why we are doing it. If somebody asks you, then you can answer. The reason, write down reason why we are doing it. The price of the bond and market interest rates are inversely related. The price of the bond and market interest rates are inversely related. Thus, if the interest rates are expected to be lower by 0.25%, the bond price is expected to rise. Next line, write down, also duration measures the price sensitivity of the bond. Higher the duration, higher the price sensitivity. Higher the duration, higher the price sensitivity. Therefore, portfolio manager will be able to maximize his profits. If the average duration of the portfolio is increased. if the average duration of the portfolio is increased. If the average duration of the portfolio is increased. So you will profit more from the falling market rate if the duration of the bond is higher. So that is another application of the concept of duration. During falling interest rate, invest in bonds with higher duration. Now write down what specifically we will do in this question. This was a general discussion on what fund managers do when market interest rates are expected to fall. In this question, now write down, let us assume that the portfolio manager sells GOI 2006 bonds. So we'll sell GOI 2006 bond, it has a lower duration, and purchase GOI 2032 bonds, because it has higher duration. Then your any other alternative answer is also possible, which means you can also sell 2010 bonds also. If you are very sure that interest rates will fall and if you are willing to take risk, you can even sell 2010 bonds and put money in 2032 bonds. You can sell 2015 bonds also. But what happens if you put all your funds in 2032 bonds and suppose your expectation does not materialize? If your expectation does not materialize, that means the rate of interest instead of falling goes up and you put all your money in 2032 bonds, there will be a huge loss. So therefore, as a student, we will play safe. We will sell only one bond which has lowest duration and will buy the bond which have got the highest duration. So now your question is, compute the revised duration of portfolio. So please write calculation of revised duration of portfolio. Calculation of revised duration of portfolio. Calculation of revised duration of the portfolio. Under that write 4 columns. Same 4 columns: government bond, duration, investment, duration into investment. So don't write 2006 now. We have sold it, and that money we are going to add in 2032 bonds. Duration is already given in the question. Duration will take the same duration because we are taking the decision before the change in the YTM. That is how the fund manager has to anticipate. You also, when you invest in share market, you anticipate what will happen to the price. Accordingly, you buy or sell first, right? So now investment in 2010 will be same 1522, but investment in 2032 bond will increase. The amount which was there in 2006 bond, you bring it and you invest in 2032 bond. So that is 10.375. Now multiply and take total. Use memory plus function, please. Use memory plus function. Yes, total of the last column: Divya, Devika, Roshni, Hari, total of the last column. I want to know whether you are listening to me or not, awake or not. Okay, so one student got the answer 256.5. Very good, thumbs up. And total investment will remain same. Total of last column divided by this will give you revised duration. It should be higher than the previous answer. So write down weighted average duration is equal to total of last column 256.5 divided by 26.375. So that is 9.73 year. 9.73 years. Okay. Now, case 2 write down. Case 2. Just reverse the answer now. Interest rates are expected to rise by 75 basis points. Interest rates are expected to rise by 75 basis points. So if the market interest rate rises, bond price will fall. The bond price will fall more if the duration is more. So what I should do? What should I do? Any suggestion? Market rate of interest will rise, bond price will fall. Bond price will fall more if duration is high. So I have to shift the funds immediately from the bonds with higher duration to the bonds with lower duration. So I will sell 2032 bonds and buy 2006 bond. Very good answer. Students are now learning this concept. I am very happy. So write down, in this case, the strategy should be to decrease the average duration of the portfolio. Because you know that the bond prices are going to fall. So you will take a lower hit if you shift your funds from higher duration bond to lower duration bond. That is, the portfolio manager should sell the bonds with higher duration and buy the bonds with lower duration. The reasoning is same. If you want to write again, you can write reasoning. The price of the bond and market interest rates are inversely related. The price of the bond and the market interest rates are inversely related. If interest rates are expected to rise by 0.75%, the bond price is expected to fall. Then write down same sentence. If you want to write it, otherwise you can skip it. Duration measures the price sensitivity of the bond. Higher the duration, higher the price sensitivity. Thus, the portfolio manager will be able to, underline, minimize his losses. Portfolio manager will be able to minimize his losses if the average duration of the portfolio is reduced. So that is what is happening across the globe right now. Interest rates are rising and they are shifting the funds from high duration bond to low duration bond. Very practical question, and that is why I said it is a likely question in the upcoming exams. So what specific action we will take, write down. Let us assume that the portfolio manager sells 2032 bonds. And purchases GOI 2006 bonds. Any other alternative answer is also possible. That means you can also sell 2022 bonds because that also has a very high duration. So you can, maybe some fund manager can sell 2022 and 2032 both and put the entire money in 2006 bond. So it may vary from fund manager to fund manager depending upon how convinced they are about the rise in the interest rate, because expectations may or may not materialize. You are a student, you know what you expect after your exam is over and what you get in the mark sheet. Sometimes there is a deviation, positive also, not negative every time. Is it right? So expectations can change, the actual outcome can be different from expectation, and therefore one can take a risk according to his risk taking ability. Now the last part of this answer, calculation of revised duration of portfolio. Calculation of revised duration of portfolio, format is same, little fast. Government bond, duration, investment, duration into investment. Then solve yourself. Please solve yourself. Solve yourself and give me the final answer. This time we have shifted the funds to 2006 bond. So 2006 bond investment will be 10.375. So please tell me the total of last column. Anybody? Total of last column. Total of last column 157.94. 157.94. Write down these two numbers, you can check it later, and write down below weighted average duration. Weighted average duration is equal to 157.94 divided by 26.375. So that is 5.98 years. So you have reduced your average duration of the portfolio. So there will be a loss, but the loss will be limited compared to the earlier situation. That is my purpose. Done. Question number 55. 6-mark question from November 2008 exam. Write down again one more time, very important. Must practice before the exam. 51 number, 52 number, 55 number. 3 questions I said today, very important. So the question is, Excel Ispat Limited has made an issue of 14% non-convertible debenture on 1st January 2007. These debentures have a face value of rupees 100 and is currently traded in the market at a price of 90 and face value is 100. Coupon rate is 14%. So its YTM must be higher than 14% because it is trading at a discount. Interest on these NCDs will be paid through post-dated checks dated 30th June and 31st December. Oh my God. So this is a semi-annual coupon paying bond. Underline. This is a semi-annual coupon paying bond. So we'll have to be very careful. Coupon rate will have to divide by 2. Number of years will multiply by 2. Discount rate will divide by 2. Interest payment for the first 3 years will be paid in advance through post-dated check. Does it make a difference in your answer? Say yes or no. Does it make a difference in your answer? You are going to pay, but you are going to issue post dated checks. So amount will be transferred to the bondholder account only on the respective date. So this line will not affect your answer. Very good. This line will not affect your answer. Unnecessary given to confuse you. Then while the last 2 years post dated checks will be issued at the third year, again useless line. This whole thing is useless, which means the total term to maturity is 5 years. The bond is redeemable at par. Redemption is at par on 31st December 11 at the end of 5th year. So total life of the bond is 5 years. You can count also 1st January 2007 to 31st December 2011, 5 years. So what are the calculation? Very good question. They have asked many concepts in one problem. Current yield, YTM, duration, and assuming that intermediate coupon payments are not available for reinvestment. Assuming that intermediate coupon payments are not available for reinvestment, that means the coupon that you will get, you will not be able to reinvest. So the reinvestment rate is 0. What is the realized yield on NCD? So one more question there was realized yield to maturity, which we have done in the previous lecture. Realized yield to maturity. So one question and many concepts are tested. So first we'll take current yield. Write down current yield is equal to annual coupon divided by current market price. Annual coupon is 14, current market price is 90, 15.55%, or you can first compute for 6 months and then multiply by 2, or you can write 7 by 90, that is for 6 months. How much is that? 7 by 90 is 7.777% for 6 months. That is 15.55% per annum. Both way you can present this or this. So that is current yield. Now I will compute YTM using formula because it's a coupon bond. So using formula will compute. You can also compute using IRR. Both are okay. So first write the formula. Always in the exam, write the formula first. Explain the terms used in the formula. Then solve for exam purpose. Today we will not write in the notebook. We don't have so much time. We have already understood. So only write the formula first. After writing the formula, put the numbers. First we'll do the calculation for semi-annual bond. Then multiply by 2. So if the coupon rate is 14% per annum, it will be 7% for 6 months. Plus 100 is redemption value, 90 is current market price. Number of half years will be 5 into 2. Number of half years will be 5 into 2 upon 100 plus 90 by 2. So kindly reply. Check the answer. It is 8.42% for 6 months. It is 8.42% for 6 months. So you have to write double 16.84% per annum. Compounded half yearly. 16.84% per annum. Compounded half yearly. Compounded but half yearly. So this is a formula method. Suppose you insist that we should solve by IRR method also, write down alternatively. In the exam you have to solve only once. So this time we are going to solve it again by using IRR method. Under IRR method, we will take one lower discount rate, we'll take one higher discount rate. You have already solved and you have got 8.42%, which means your answer IRR will be somewhere around this same answer, 8.42. So write down 8 as a lower rate, 9 as a higher rate, and there will be 10 half years. Format. First write down period. One period is equal to 6 months. Cash flow. Discount rate 8%. Under that two column, discounting factor and discounted cash flow. Then 9%, two columns, discounting factor, discounted cash flow. In the exam, you can solve only by formula method or only by this IRR method. Year 0, you have to invest 90 rupees. For 10 half periods, each half year, you will get 7 rupees. And in the last year, you will get 100 rupees. Now solve. Use your calculator. Get the annuity factor for 8% and 10 periods. So it is 6.71. Try the next 10th period factor 0.46319. Yes, Divya, please tell me the total of this column. Muralidharan, what is the total? At 8%. Total of this is 3.29 positive. If it is positive, which means my IRR is more than 8%. So now you try at 9%. Now you try at 9%. Try 9%. 3.29 is right. Divya is right. Then try 9%. Try 9%. What is the total of last column? Total of the last column is negative 2.84. Check the answer. Negative 2.84. So the answer is somewhere between these two. One is positive, one is negative. So the answer is somewhere between these two. So write down the formula of IRR. IRR or YTM is equal to start rate means lower rate. You can say lower rate. Lower rate plus surplus means NPV at lower rate upon NPV at lower rate, then minus NPV at higher rate into higher rate minus lower rate, if you are more comfortable with this. Put the values now. Yes, please put the values. 8 plus in bracket 3.29 upon 3.29 minus minus will become plus. Minus minus will become plus 2.84 into 9 minus 8. At least now you should answer what is the IRR. So you are getting 8.54%, but that is for 6 months because we have done all calculation for 6 months. So you will write YTM annual is equal to multiply by 2 17.8% per annum compounded half yearly. compounded half yearly. Okay, compounded half yearly. So using this IRR technique, my answer is 17.08, whereas earlier method, formula method, the answer was 8.53. Sorry, what was that? 16 point something, 16.84. The earlier answer was 16.84. Right. So this is more accurate. This is more accurate. Formula method is less accurate. So we have got current yield, we have got YTM. Now the next task is calculation of duration. Oh, and this is a semi-annual bond. 5 year is equal to 10 half years. So we'll have to do the calculation. Oh my God, 10 times. Write down. Calculation of duration. Calculation of duration. Format is same. So what I have done, I have taken 8.54% as a discounted because this is more accurate. This is more accurate, and discount rate will also be based on 6 months. So draw the format first. Same format of duration. Same format of duration. Solve. First you write down period 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Cash flow will be 7, 7, 7, 9 times, and in the last year 107. In the last year 107. In the last year 107. Type on your calculator 1 divided by 1.0854. Press equal to 0.9213, 0.8488, 0.7820, 0.7205, 0.6638, 0.6116, 0.5635, 0.5191, 0.4783, 0.4407. Now my task is over. Your task starts. Multiply equal to memory plus, multiply equal to memory plus, and complete these two columns. Complete these two columns. I will give you 40 seconds to complete. Is it right? This question was asked in the exam. Complete, please, little fast. The present value should be approximately 90 rupees because this 90 rupees is already given in the question. So you can directly write 90 here. Okay. If you are getting close to 90, you are right. Using 90 rupees present value of the bond, we have got the factor. So using the factor, I should get the same present value also. Okay. Yes, very good. Now next you try the last column. Period into present value. And use memory plus function for faster totaling. Try, keep adding, try and try. Check the answer. Are you getting around 662.211? Please confirm approximately. 662.211 approximately. Yes, 89.95 is also right. One student is saying 89.95. Very good. And what is the total of last column? Total of last column. So you all of you please note down this number and we can check later. You can check later. Write down in the notebook 662.2115 approximately. Right below duration. Right below duration. Total of the last column 662.2115 divide by total of the fourth column 89.91. If you have got 95, write 89.95. But this is not the final answer. This is for half years. 7.36468 approximately. Our bond has a maturity of 5 years. How can duration be 7.36 year? No, it is 7.36 for half year. To convert into annual, divide by 2. Divide by 2. Don't further multiply by 2. Don't further multiply by 2. So now write down duration is equal to annual. This answer divide by 2. So you have to give an answer which is below 5 years. So this is how you can compute the duration of a semi-annual bond. Okay. So this is your answer for annual. One more question is there. Oh, what was that last question? In the last line of the question, please come to your question point number 3. Assuming that intermediate coupon payments are not available for reinvestment, calculate the realized yield on the NCD. So today you will invest 90 rupees in year 0. Then you will get 7 rupees, 7 rupees, 7 rupee for 10 years, and in the last year you will get 107 rupees. This amount that you will receive, you will be able to reinvest at 0% interest rate. Means 7 rupee after the end of the period will also be 7 only. So assuming that interest rate is 0, you cannot reinvest this coupon. What will be the realized yield to maturity? So I have to first find out a lump sum amount here on maturity, terminal value on maturity. Coupon will be received 10 times, 70 rupees plus 100 rupees principal I will receive. So I will get 170 after 5 years. And how much amount did we invest? 90 rupees. So 90 rupees becomes 170 after 5 years. But because it's a semi-annual problem, we will take R by 2, N multiplied by 2 and find out what is the value of R. So we have to solve again one equation. For that, first we need to find out the terminal value. What will be the lump sum amount you will receive at the end of 5th year? Write down the heading calculation of realized yield. Calculation of realized yield. Very easy question, but very good question because it has tested several things. in one problem by giving a semi-annual bond. So write down calculation of realized yield. First we'll write total interest received 7 into 10 times. 7 into 10 times. 7 into 10 times. 7 into 10 times 70 rupees. Face value on redemption. Face value on redemption 100 rupees. So total cash flow 170 rupees. And investment made was 90 rupees. 90 rupees becomes 170 after 5 years. So what is the rate of return you have earned? But first you will have to do the calculation in half year terms and then convert into annual terms. So write down this equation. Future value is equal to, already we have done earlier 3 problems of this type, present value into 1 plus r by 2 to the power n into 2. R by 2 because it's a semi-annual coupon paying bond. Now I will put the numbers, you will solve. This time I will not solve. 170 equal to 90 into 1 plus r by 2 means 0.5 r. R by 2 means 0.5 r. Power will be 5 into 2 means 10. So when you simplify, it will be like this. 170 by 90 is 1.88889 is equal to 1 plus 0.5 r to the power 10. Okay. Can you further simplify this? 1 plus 0.5 r will be equal to 10th root of 1.88889. So 1 plus 0.5 r will be equal to 1.88889 to the power 1 by 10, and 1 by 10 means 0.10. 1 by 10 means 0.10. So now you have to use your calculator trick to solve this part. I'll give you some seconds to try. Okay, try and give me the answer for R. I have already explained in the last few lectures how to get it. So you will get for this part an answer 1.06566695, something like that. You can round off if you want. Please confirm, is it right? Yes, students, please confirm, is it right? Please confirm, is it right? And now you can just find the value of R by solving this simple equation. Your R will be equal to 13.13% per annum compounded half yearly. Yes, very good. Come on, check 13.13% is right. So that was a very good question number 55. So we have solved 55 questions till now, and some homeworks were also given. So please tell me, have you tried homework questions? Quickly reply. Have you tried the homework questions? At least one or two? Yes sir, very good. Now I will give you one more concept called duration of a perpetual bond. What is a perpetual bond? What is a perpetual bond? It only pays you coupon. It does not pay you the principal amount. So there is no maturity. There is no number of years. Is it right? The number of years are infinite. So therefore, the duration of a perpetual bond will be calculated by a different formula, not by the earlier formula, because in earlier formula we will require number of years. So this formula has been derived. It's a derived formula. Okay, so we will not derive the formula in the classroom, not required. It will require some more mathematical skill. So duration will be equal to 1 plus YTM upon YTM. Very simple formula, 1 plus YTM upon YTM. When the number of years becomes infinite, then the formula is reduced to 1 plus YTM upon YTM. So there is a question number 56 which is based on the concept of perpetual bond. Are you ready? First tell me, are you ready to solve or are you tired? Ready or tired? Yes, reply. So we are ready. A person has a portfolio comprising of 60% of bond A and 40% of bond B. Bond A is a 5-year zero coupon bond. Very good. Duration is 5 years. Face value is 10,000. Presently yielding 11%. Bond B is a perpetual bond of the face value 100. Coupon rate is 10%. Means 10 rupee coupon. And the market price is rupees 88. Calculate the duration of the portfolio. So duration of portfolio is weighted average duration. Okay. That means I need two things. I need weight of each security. So weight of bond A is 60%, weight of bond A B is 40%. Duration of zero coupon bond is 5 years. So first I need to find out what is the duration of that perpetual bond. And for finding the duration of perpetual bond, we need to find out what is the YTM of the perpetual bond. Because once you get the YTM of the perpetual bond, you will get the duration of perpetual bond. And from duration of perpetual bond, you will be able to find out the weighted average duration. Is it right? So what is my thought process? My thought process is that what do I need? I need YTM of perpetual bond first. So first write down in your notebook, step 1, duration of ZCB, that is already given. Duration of ZCB is equal to maturity, is equal to 5 years. Duration of zero coupon bond is equal to 5 years, but duration of perpetual bond I will first compute YTM. So write down YTM of bond B. Step 2 is YTM of bond B, that is perpetual bond, is coupon divided by current market price. Coupon divided by current market price. Coupon is 10% of 100 divided by 88. So the answer is 11.36%. Now using that 11.36%, you will be able to compute the duration of perpetual bond. Right below step 3, duration of bond B. Duration of bond B will be 1 plus YTM divided by YTM. 1 plus YTM divided by YTM. So how much is that? 1 plus 0.1136 divided by 0.1136. So that comes to 9.803 years. 9.803 years. Is it right? Say yes or no. Now you can find out duration of portfolio. So step 4, write down duration of portfolio, which is equal to weighted average duration, which is equal to weighted average duration. And then how do we solve it? By multiplying weight into duration. So for bond A, the weight is 0.6, duration is 5, 0.6 into 5, plus for bond B, the weight is 0.4 and duration we have computed is 9.803 into 9.803. So learned student, please reply now. What is the answer? Yes, answer please. Anybody? Any student? Please reply. The answer is how much? 6.9 years. Very good. Very good. 6.92 also you can write. 6.92 is also right. Don't worry. So this is my question number 56, where we have seen the application of perpetual bond duration. So I have taken duration of coupon bond, semi-annual coupon bond, zero coupon bond, and we have also taken perpetual bond. Come to question number 57. Question number 57. Mr. A is planning for making investment in bonds of one of the two companies, X Limited and Y Limited. So this question also you mark important. The source I have not written, but it is from one of the institute publication only. This is important. Institute has asked this question in one of the exams or MTP, RTB. Mr. A is planning for making investment in bond of one of the two companies, X and Y. The details of these bonds are: X Limited bond has a face value of 10,000, coupon rate 6%, maturity 5 year, and Y Limited 10,000, 4%, 5 year. The current market price of X Limited bond is, so for this company, the current market price is given, face value is given, coupon is given, years are given, and it says both bonds have same yield to maturity. So first you will find the YTM of bond X using this price given, and once you find the YTM of bond X, the same YTM applies for bond Y also. Since Mr. A considers duration of the bond as a basis of decision making, so because YTM is going to be the same, so he wants to use duration for decision making, you are required to calculate duration of each bond and your decision. So what will be my thought process in this question? That first I need to find the YTM of X. Same YTM applies for Y. Then compute duration of X and duration of Y. And the one which will have lower duration, that we will select, because lower duration will have lower risk. If you are getting same YTM, then we'll choose the option which has lower risk. So we'll choose the bond which will have lower duration. Is it right? So first step 1, write down. We will write in the notebook. Calculation of YTM of bond X. Calculation of YTM of bond X. It's a coupon paying bond, so I can use the formula, or I can use the IRR also. So write down the formula. After writing the formula, we'll have to solve. So I will put the values in front of you and the student will solve it and give me the answer. Okay. Yes, please reply. What is the YTM of bond X? What is the YTM of bond X? Anybody? YTM of bond X? Nobody is replying. Yes, come on. What happened? Where are you all? So the answer is check 4.23% approximately. Check 4.23% approximately. Right, approximately, because we are using formula method. So the same YTM applies to bond Y also. Okay. So YTM of bond Y will also be 4.23%. Now we'll compute duration of both bonds at 4.23% discount rate. So write down step 2, computation of duration of bond X. So in this example, the duration is used for decision making, and the investor says I will choose the bond which has lower duration. So duration of bond X, write down the format: year, cash flow, discounting factor at 4.23%, present value into year. We are solving question number 57, taken from one of the publications of the institute only. Cash flow, write down 6% of 10,000, 600, 600, 600, 600, last year 10,600. Now solve. Take the factor at 4.23%. 1 divided by 1.0423 equal to, write the factor, equal to, and keep writing the factors. So these are the factors. Now just kindly multiply and add. Multiply and add. Use memory plus function for faster calculation. Use memory plus function. Check the answer. How much you are getting approximately? Now you compute the last column, multiply and use memory plus function. Total of the last column. Check the answer please, 48,387.04. All of you please note down this number. Later on you can check. So therefore write below duration is equal to this total divided by this total, 4.49 years. 4.49 years. Just confirm, is it right? Is it right? Okay, 4.49 years. Do the same exercise for bond Y. Write down step 3. Duration of bond Y. Here also I am going to take same YTM because that is what is written in the problem. This bond has coupon rate 4%. This bond has coupon rate 4%. So 4% of 10,400 rupees 4 times, and last year 10,400. Copy the factors from the previous calculation. Don't waste time on factor calculation again. factors are same, copy. And now you multiply cash flow and the PV factors. Use memory plus function, easy to take total. Both bonds have same YTM as per the question, but they will have different duration because their coupon rates are different. So tell me the total of this PV column. Anybody? PV column total? Yes, come on. Please reply fast. Come on. Divya, Devika, Roshni. 9898 point something. Very good. And now you tell me the total of last column. All of you, once again, total of last column. You have to answer fast so that I will understand whether you are following my instruction or not and whether my speed is accurate or not. Otherwise, I might keep waiting for your answer. What is the total of last column? Yes, write down the answer. Total of the last column. So it comes to approximately, check, 45806 approximately, plus minus 1 or 2 rupees is okay. Therefore, duration will be equal to 4.63 year. 4.63 year. Duration will be equal to 4.63 year. Correct? Now, which bond has lower duration? Bond X has lower duration. So, what will you do? You will prefer bond X because duration is lower. So, risk is lower. Risk is lower. YTM is same, means if you purchase the bond, you will get same rate of return, but risk is lower. So bond X will be preferred. Now in this question, actually we don't have to compute duration because we have seen one of the properties of the bond, that the bond with lower coupon will have higher duration. This bond Y has lower coupon, and that is why it has got higher duration. So if I apply the property of duration, the bonds with lower coupon will have higher duration and hence it will be riskier. But in the exam you don't do that because specifically they have asked you to compute duration. You need to do it. Now we'll go to one very important question, number 58. Okay, 58 number. A fund manager has the following portfolio: bond A, bond B, C, D. Market values are given in rupees in lakhs and duration is also given. What is the duration of the portfolio? What is the duration of the portfolio? Weighted average duration. So in this column, you will multiply, add and divide by the total of market value. So I have kept that last column blank in your book so that first answer you can solve in the book only. If the yield is 12%, means YTM is 12%, what is the price volatility of the bond? You have to find modified duration. Duration divided by 1 plus YTM is modified duration, which is the volatility of the bond. And if the interest rate are expected to fall by 70 basis point, if interest rate will fall, bond price will rise. What is the expected market value of the portfolio? So portfolio value will increase to the extent of 0.7 into modified duration. portfolio value will increase to the extent of change in YTM into modified duration. Add that amount to the existing value of the portfolio. That will be the revised value of your portfolio. And one more question. What portfolio churning advice you would give? So if the interest rates are expected to fall, bond prices are expected to rise. The one which has lowest duration, we are going to sell, and the one which has got higher duration, we are going to buy, like one earlier problem, and this will help us to get maximum benefit from our expectation. Then calculate revised duration also. Oh my God, in one question so many things they have asked you. Okay, so please first compute the duration of the portfolio. In your book you can complete the last column so that you can save time. 200 into 6, 1200, 300 into 2, 600, 400 into 3, 1200, 900, total 3900, and total of the market value of investment is 1000. 3900 divided by 1000 will give you duration of the bond portfolio 3.9 years. Duration is 3.9 years. Very good. Those who are replying, very good. Now write down next line, price volatility. Price volatility means modified duration. Modified duration is equal to duration upon 1 plus YTM. Duration upon 1 plus YTM. 3.9 upon 1.12. 3.9 upon 1.12, and that is equal to 3.48. Is right, 3.48. So how do you interpret that modified duration of 3.48? It means, write down, it means if YTM changes by 1%, bond price will change by 3.48% in opposite direction. Bond price will change by 3.48% in opposite direction. But in this problem they are saying bond price, the YTM will fall by 70 basis point. So write down below, step 3, revised portfolio value. Revised portfolio value. So first we'll check by what percentage portfolio value will increase. Bond value will increase because YTM is going down. So if YTM goes down, bond value will go up to the extent of the change in yield into modified duration. So write, if yield falls by 0.7%, if yield falls by 0.7%, the bond price will rise by 0.7 into 3.48. 0.7 into 3.48 means 2.44%. 2.44%. Therefore, revised portfolio value equal to 1000 plus 2.44%. 1000 plus 2.44%, that is equal to 1024.40. 1024.40. Next question is, what portfolio churning advice you would give? Yes, which bond you will sell? Please answer. Which bond you will sell? The one with lowest duration, that is bond B. And which bond you will buy? The one with higher duration, that is bond D. So step 4, write down. Step 4, portfolio churning advice. Step 4, portfolio churning advice. Portfolio churning advice, write down. If yield is expected to fall by, if yield is expected to fall by 0.7%, bond prices are expected to rise. Bond prices are expected to rise. Therefore, we should increase the average duration. Therefore, we should increase the average duration of the portfolio. Okay. As you know from the earlier example also, we'll sell bond which has lowest duration and buy bonds which is having highest duration. So write down strategy. Sell bond B and invest the proceeds in bond D. Sell bond B and invest the proceeds in bond D. So what will be my revised portfolio duration? My revised portfolio duration will be equal to 200 into 6. That will not change. This is bond A. Bond B will not be there. Bond C, 400 into 3 will be there. And bond D will have now 300 plus 100. 300 amount realized from selling bond B and 100 is already there in bond D. So 400, and my total investment will be same 1000. So please check the answer now. Is the answer 6 years? Is the answer 6 year? Okay. Any query now? So these were so many questions on duration. One more concept you will learn today which will require duration and very important for exam is called interest immunization. So have you heard this word immunization? When you were born, you were given after some time polio vaccine. So vaccine will immunize you from certain disease. So immunization means to protect from risk. To protect from risk. Immunization means to protect from risk. Is it right? Now what is the risk of holding bond? What is the risk of holding bond? There are two risks of holding bond. For the purpose of interest immunization discussion, one is that market interest rate increases. If market interest rate increases, the risk is that bond value will fall. And second risk, if market rate decreases, so the risk is that reinvestment income will fall. Reinvestment income will fall. Oh my God. So if market rate increases, or market rate decreases, I am carrying one of the risk. So if market rate increases, there is one disadvantage, bond value will fall, but there is one advantage also. Reinvestment income will go up. And if market rate of interest decreases, there is a disadvantage, but there is an advantage also. Bond values will rise. Bond value will rise. So what is interest immunization? It is a strategy whereby, very interesting, it's a strategy whereby the loss due to value, change in value of the bond, fall in the value of the bond will be compensated by the gain on reinvestment income. Similarly, the loss in reinvestment income will be compensated by the gain in the value of the bond. So if the loss in reinvestment income is compensated by gain in the value of the bond, then you are protected from the risk. Similarly, here also, fall in the value of the bond is compensated by the reinvestment income gain, you are protected from the risk. So this concept of immunization is very interesting. Suppose you want to hold the bond for 6 years. You want to sell the bond after 6 years because you want to use that money for some business purpose. In year 0, you invest amount. You want to sell the bond after 6 years. So you are carrying a risk that your desired amount of money at this point may not be realized. Either the interest rate may fall or interest rate may rise. So you have to ensure that whether the interest rate fall or interest rate rise, you should be able to achieve your desired target value over here. And how do we achieve that? That is the strategy called interest immunization. So interest immunization will ensure that the investor is protected from the fluctuation in the market interest rate. The loss in one is compensated by the gain in another. So I will read the note, you will understand. Question number, some homework you have to write down today. They are same type of question. Question number 59, then 60, 61, 61 up to 62. Okay, you will try as homework. We have done all questions of the similar type in the class. You will be able to do. Don't worry. If you have doubt, you will ask me. Will you do the homework? Tell me yes or no. Yes or no. Option A yes, option B no. Up to 62. You will complete in the notebook. The student is saying yes sir. We will do the homework. Very good. If you also do some question, then all exam question, RTP, MTP study material will get covered in the class itself. Okay, I can solve each and every question in class, but then your batch duration will exceed like anything, and most of these questions which I am giving as homework are similar to the one we have solved in class. You have to just practice yourself. So come back to paragraph 34, interest immunization. Investment in bond is subject to interest rate risk, means it can change, because of which bond value will change, and reinvestment rate risk. That means you will not be able to reinvest the coupon at the same rate. So this changing interest rate affect the bond in two ways. There will be a change in the value of the bond. In the last so many questions we have seen, and there will be change in the income from reinvestment. change in the interest rate have an opposite effect in change in bond value and reinvestment income. So if this goes up, this goes down. If this goes down, this goes up. So if interest rate increases, just a second, if interest rate increases, bond value will reduce, but income from reinvestment will increase and vice versa. Have you understood? Now next is, so what I am going to do, immunization is a strategy that takes care of these two risks by ensuring that a change in interest rate will not affect the expected return from bond portfolio. So sir, what we are going to do? We are going to ensure that the loss in one is compensated by the gain in other. So irrespective of whether the interest rate fall or interest rate rise, we will get our desired return. So the strategy is, underline this whole thing, a portfolio is immunized. A portfolio is immunized means protected from changing interest rate if the duration of the portfolio is equal to the desired time horizon. If the duration of the portfolio is equal to the desired time horizon, what does that mean? It means if I want to hold the portfolio for 6 years, the duration of the portfolio should be 6 years. If duration of the portfolio matches with my desired time horizon, then I am protected from the interest rate fluctuation risk. Okay, in other words, the average duration of the portfolio equals the investor's planned investment period. Okay, suppose Devika wants to go to USA after 4 years to study MBA, and she has got investment in bonds. So she would require, say, 25 lakh rupees after 4 years. She has invested in bonds, but the problem is that after 4 years, when she will sell the bond, that time she may or may not receive 25 lakh rupees because interest rate will change, bond value will change. So therefore she has to create a portfolio of bond. Portfolio duration should be equal to, yes, how many years? 4 years. So if you can create a portfolio with duration 4 years, you will get your desired return, and we are going to prove that with the help of some numbers. So interest immunization refers to a situation where the duration of the asset is matched with the duration of liabilities. So we have to pay after 4 years 25 lakhs. So duration of my liability is 4 years because I have to pay 25 lakh fees. So I will create duration of the bond portfolio which should also be 4 years, and that will eliminate my interest rate risk. So the summary of our discussion is, if you want to protect portfolio from interest rate fluctuation, you have to ensure duration of the asset is equal to duration of the liabilities. Okay, sir, please explain with one example. So here is the example for you. Please come to question number 63. This question number 63 is taken from a reference book. This question was taken because I wanted to prove that whether market rate goes up or market rate falls, your bond portfolio is immunized. There is no such question in the study material or the exam question also. So we wanted to take a problem which will convince the student that this strategy of immunization works. Okay, so 63 number question. Can you see 63 number printed below? Mr. X has to pay rupees 10,000 after 5 years from today. He wants to fund this obligation today only. He wants to fund this obligation today only. So this fellow has to pay 10,000 after 5 years. So he has a liability to pay 10,000 after 5 years. So this is the duration of liability. Duration of liability is 5 years because he has a obligation to pay 10,000 after 5 years. On inquiry, he gathers that a company has come out with a initial public offer of 8% bond, face value rupees 100, maturity 6 years, interest is payable annually. So the coupon rate of this bond is 8%, face value is 100, maturity of the bond is 6 years, but you want money after 5 years. If you want money after 5 years and the term to maturity is 6 years, you will have to sell the bond at the end of 5th year. You have to sell the bond at the end of 5th year, and at the end of 5th year, if the interest rate have changed, you might gain or you might lose. He invests 6,800 in the offer because he wanted to ensure that this 6,800 with coupons will become 10,000 rupees after 5 years and he can pay his liability. So first question is, what is the duration of this bond? This bond, simple question, 8%, face value 100, maturity 6 years. So you have to find the duration of this bond. Okay, and it was issued at par, so the discount rate will also be 8%. It was issued at par, so discount rate will also be 8%. What amount he will accumulate if the market interest rate continues to be 8%? That means suppose the market rate does not change only, it remains 8% for the 5-year period. How much amount he will get after 5 years? That was easy. If the market rate falls to 6%, let us say the market interest rate falls to 6%. After he bought the bond, the market rate has gone down to 6%. Or case 2, market rate rises to 10%. Oh, immediately after his investment in the bond, how much amount he will receive at the end of 5th year, because he wants to pay a liability at the end of 5th year, 10,000 rupees. So he wants to ensure that he should have 10,000 rupees in his pocket after 5 years. So let us see whether this strategy will work or not. So for that, first I will compute duration. What is his liability period? 5 years. Duration of liability is 5 years. So if he invests in a bond whose duration is also 5 years, he will be protected from the interest rate risk. But I have to prove that, otherwise you will not be convinced. Right. Calculation of duration. Calculation of duration. Draw the format. Year cash flow, discounting factor at 8%, present value into year, present value into year. First write down year 1, 2, 3, 4, 5. The total term to maturity of the bond is 6 years. We want to hold it for 5 years and then sell it. And what will be your coupon amount? 6800 is the face value of the bond you have bought into 8%, or you can simply take 100 rupees into 8%, because duration in years will not change whether you take 100 rupees or 6,800 rupees for calculation. So we'll take 8% of 6800. You can only take 8 rupees also to solve. Last year he will get 544 plus 6800, 7344. So this will be his cash flows if he holds the bond till maturity. Okay. Discounting factor, write down 0.926, 0.857, 0.794. 0.735, 0.681 and 0.630. Okay, so we have designed the book in such a manner that all concepts are at one place and all questions relating to that at one place, accumulated from all the sources. You don't have to now search in RTP what has come, MTP what has come on this topic. All question on RTP, MTP, study material and exam under one particular heading I have brought. Okay, so solve now. Please solve. Give me the answer here. Present value. It took so many years to compile this book, but now it has come out quite well. Yes or no? Did you like our book or not? Say yes or no. Everybody. So what is the answer of present value? So one student said yes, we liked your book. Very good. Thank you. Total. It should come to close to 6800. Yes, it should come close to 6800 because the coupon rate and discount rate are same. So ideally we should get 6800, but if you get something different, then also it's okay. Minor difference is okay. Come to the next column. Multiply year into present value, memory plus. Give me the total of last column. Give me the total of last column. And we have designed the presentation in such a manner also that you can follow the speed of the classroom. Line by line each item will appear. So this is how much? Approximately check 34064. 34064. 34064. Now tell me the duration. Duration of the bond is, it should be 34064 divided by 6799, 5.01 year. That is what I wanted. I wanted that duration of my bond should be equal to 5 years, which is the duration of my liability. But now the important task is to prove that your strategy will work whether the market rate of interest remains same 8%, falls to 6%, rises to 10%. You will have 10,000 rupees on maturity. After that is after 5 years, when you will sell the bond plus the reinvested coupon, you should have 10,000 rupees with you. If that happens, you are immunized. You can sleep peacefully. Okay. So write down case 1. 3 times I have to present the answer in front of you. One at 8%, one at 6%, one at 10%. So please write down. And you have to use your calculator fast. Case 1, market interest rate continues to be 8%. Market interest rate continues to be 8%. Draw one table. I will reinvest the coupon at 8% and I will sell the bond after 5 years using 8% discount rate. So first column is year, cash flow and accumulated amount means future value. Future value is equal to present value into 1 plus 0.08 to the power n. We have to receive the amount at the end of 5th year because I need to pay the liability. So if you receive coupon in year 1, you will be able to reinvest it for 4 years. Because I need funds at the end of 5th year, so I will reinvest it for 4 more years. I will receive at the end of year 1 and I will recover at the end of year 5. So there is a gap of 4 years. So how much cash flow I will get? 544 into 1.08 to the power 4. Check the answer. This 544 you will reinvest at 8% for 4 years. So your cash flow after or cash flow at the end of 5th year will be 740. Try this one. This 544 which you will receive at the end of year 2 can be invested for 3 years. So you will get 685. This 544 you get at the end of year 3, you will invest for 2 years, 635, 588, and this is 544. Wait, one more thing. Wait. Don't take total. Now, in the 6th year, in the 5th year only, 5th year, I am going to sell the bond. I am going to sell the bond which will be equal to present value of 6th year cash flow. In 6th year, the cash flow from the bond will be 544 towards coupon and 6800 towards principal. So this cash flow will be received at the end of 6th year, but I am going to sell it at the end of 5th year. So I will discount it by using 8% discount rate. So you write like this: 6800 plus 544 and compute the present value by using 1 year factor, divide by 1.08. So that comes to 6800 only. Now you add this. That will give me the amount at the end of 5th year, and I will use that money to pay my liability. So this is coming to approximately 9992, and I have to pay 10,000. So there is no major difference. I have to pay 10,000 and the amount I have accumulated is 9992. So almost equal. So 8 rupee difference ignore. But the interesting part will be the next two calculation, where the interest rate will fall to 6% and rise to 10%. Same format. Case 2 write down. Case 2. Market interest rate declines to 6%. Market interest rate declines to 6%. If market interest rate declines to 6%, then what will happen? You will be able to reinvest the coupon at 6%. And while calculating the value of the bond at the end of 5th year, you will use 6% discount rate. So write down the same format, same cash flow also, but the calculation of interest will be based on 6%. So can you please try? What will be the amount you will receive if 544 is invested at 6% for 4 years? Check the answer, 687. Try the next one, 648, 611, 577, same. And in the 5th year, you are going to sell the bond. You are going to sell the bond which will be present value of the next cash flow discounted at 6%. So write 6800 plus 544, which will be the cash flow of the 6th year, but I am going to sell it at the end of 5th year. So present value divide by 1.06. You will get 6928. Tell me the total. And that is the interesting part, that even if the market rate has gone down, you have lost on the coupon part, reinvestment income part, but you gained here on the value of the bond part. And your answer is, surprise, very close to 10,000. That is 9995. So you are convinced to some extent that this immunization strategy works if you can match duration of liability with the duration of asset. But I have to also prove that what if the interest rate rises to 10%, then also it will match to 10,000. Let us see. So case 3, write down, market interest rate rises to 10%. Will you still get 10,000? Let us see. Format is same. And then you will write the same cash flow also. This time the interest rate here is 10%. Please solve yourself and tell me the total of last column. Let me see who will give the answer first. Check the answer now. 796, 724, 658, 598, 544. And in the 5th year, when you go to sell the bond, the discount rate applicable will be 10% now. So 6800 plus 544 divided by 1.10. That is the amount you will realize at the end of 5th year by selling the bond, which is 6676, which is 6676. And now you tell me the total. Anybody for total of the last column? Surprise! You are again very close to 10,000. So this time the loss in the value of the bond is compensated by the increase in reinvestment income, and therefore you are getting same amount 10,000. Some difference is okay, minor difference is okay. So this is the benefit of learning interest immunization. This is the benefit of learning duration. This example was given so that the student should have the feeling of understanding immunization concept, even though this example is not in the study material or publications of the institute. So whenever there is a gap between the ICI publication, I have added some example so that your understanding is complete. Okay, so thank you very much. Now we'll meet on Monday at the same time. Thank you again. Enjoy your weekend. Bye bye.